Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shanghai CHICMAX Cosmetic Co. Limited annual report. Shanghai CHICMAX Cosmetic Co. Limited offers a diverse range of cosmetics products under various brands. The company provides skincare products that cater to different skin types and needs. In addition to skincare, they also offer maternity and childcare products, ensuring that new mothers and their babies have access to quality care. Their product line extends to washing and personal care items, which are essential for daily hygiene. Makeup products are also available under the KANS brand, allowing customers to enhance their appearance with a wide range of colors and finishes. The company's brands include KANS, One Leaf, Baby Elephant, KYOCA, Nupage, ARMIYO, TAZU, and Aznami. Beyond product sales, Shanghai CHICMAX Cosmetic Co. Limited also engages in enterprise management, property leasing, and transportation services. This indicates that the company has diversified its operations to provide a comprehensive range of services to its clients. The company sells its products through both online and offline channels, catering to retailers and distributors across mainland China and internationally. Shanghai CHICMAX Cosmetic Co. Limited market capitalization of $22 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Shanghai CHICMAX Cosmetic Co. Limited holds a significant advantage in their industry. Shanghai CHICMAX Cosmetic Co. Limited trades at a higher price-to-earnings ratio of 18 times and a higher price-to-book ratio of 8.17 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 38% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.48%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified by examining the key factors that contribute to an increase or decrease in revenue. For revenue growth, several factors are at play. The launch of new products and expansion into new markets have been instrumental in driving revenue growth. Strong brand power, product strength, marketing capability, channel power, and effective marketing campaigns have also contributed significantly. Additionally, awards and recognition, successful multi-brand and multi-category layout, and growth of key brands such as KANS, Nupage, and ARMIYO have all played a role. Furthermore, the company's online presence has increased, leading to higher sales through online direct channels. The expansion into new product lines and categories, such as skincare and washing and cleaning, has also driven revenue growth. Effective marketing campaigns, including documentary interview films and friendly partner programs, have helped to increase brand exposure and drive sales. On the other hand, there are limited factors that contribute to revenue decline. One notable factor is the adjustment phase and reduced marketing expenditure for Baby Elephant, which resulted in a minus 20.8% decline. Uncertain payment periods for most customers and build-based services also contributed to revenue decline. However, these factors are relatively minor compared to the numerous drivers of revenue growth. In terms of revenue growth by category, skincare has seen an increase in revenue generated from KANS, 23.1%, while maternity and childcare have experienced a significant increase in revenue generated from Nupage, 53.6%. These trends suggest that the company's focus on expanding into new markets and product lines is paying off, driving revenue growth across various categories. The financial performance of a company has undergone significant changes over the past period. A notable increase in net income is observed, with a substantial rise of 37.3%. This indicates that the company's revenue and earnings have improved significantly. However, despite this growth in net income, profit margins have experienced a slight decline from 76.4% to 75.2%. This decrease suggests that while the company is generating more revenue, it is also facing increased costs or expenses, which are eating into its profit margins. The company's financial performance has shown a significant improvement in recent years. One notable indicator of this growth is the generation of positive operating cash flow. In 2025, the company achieved an impressive operating cash flow of Rm205.2 million. This achievement demonstrates the company's ability to manage its finances effectively and generate sufficient funds from its core operations. The positive operating cash flow is a crucial metric for any business, as it indicates that the company has enough liquidity to meet its financial obligations and invest in future growth initiatives. The fact that the company was able to achieve this milestone in 2025 suggests that its operational efficiency and financial management strategies are paying off. This achievement will likely have a positive impact on the company's overall performance and provide a solid foundation for future growth. The company's debt level and interest expenses have undergone significant changes in recent years. On the one hand, the company has seen a notable increase in its interest-bearing bank borrowings, which has led to a substantial rise in interest expenses. Specifically, interest expenses on bank borrowings increased by 22% from RMB 2961 to RMB 3592. On the other hand, lease liabilities have decreased, which may indicate that the company is actively managing its debt obligations and exploring alternative financing options. However, this decrease has been offset by a significant increase in interest expenses on lease liabilities, which rose by 113% from RMB 3111 to RMB 6592. Overall, the data suggests that the company's interest expenses have increased significantly, with a total rise of 21.3% from RMB 6.1 million in 2024 to RMB 7.4 million in 2025. This increase is likely due to the rising debt level and higher interest rates on its borrowings. The company has a history of paying dividends to its shareholders. According to the report, the company paid out significant amounts in both 2024 and 2025. In 2024, the total dividend paid was RMB 511,542,000, while in 2025 it was RMB 497,572,000. The dividend payments were made at a rate of RMB 0.75 per share for the final dividend in both years, with an interim dividend of RMB 0.5 per share paid out in 2025. There is no mention of any share buyback activities by the company, indicating that it has chosen to distribute its profits to shareholders through dividends rather than repurchasing shares. Concerns have been raised regarding the accumulation of inventory and potential disruptions to supply chains. The data suggests that there may be an issue with inventory buildup, as evidenced by a significant increase in the cost of inventories sold. Specifically, this metric rose by 22% over a certain period, indicating a potential problem. Furthermore, the finished goods inventory has also seen a notable increase, rising by 3.6%. This uptick in inventory levels could be indicative of inefficiencies or imbalances within the supply chain, potentially leading to disruptions and other issues down the line. That concludes the financial summary for Shanghai CHICMAX Cosmetic Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.